Welcome to Telegeography Explains the Internet, the show that explores the business behind all of the ways humans stay connected around the world. I'm your host, Greg Bryan, and my guest today is Aaron Chan, founder and managing partner at Recurve Capital. Usually on the show, we have people working in the telecom industry or those who manage telecoms for large enterprises. But today we're going to have something of an outside perspective. Aaron is an investor in the technology, media, and telecom space, or TMT, as they say in financial circles. And he discusses with me how investors view the telecom industry and how he classifies the publicly traded telecom companies that are out there on the market. While we focus much at Telegeography on the economic geography of networks, I personally don't often consider how those factors might lead to stock growth, dividends, price to earning ratios, and those kinds of financial considerations. So it was really fascinating for me to hear Aaron provide his view of the long-term profitability of network operators and what he looks for in making investment decisions in the telecom space. We also talk about the future of the industry and what might lead to some competitive advantage for some transport data companies and how long that might last. So I really feel like I learned a lot hearing Aaron's perspective of the industry, and I hope you will too. Okay, welcome to the show, Aaron.
Thank you for having me. Really appreciate it.
No, it's my pleasure. You know, you're a little bit different of a guest, which keeps the show fun and interesting for me and for the listeners. So why don't you start out with maybe a background on yourself and how you ended up founding Recurve Capital?
Sure. So I've been in professionally investing in the public markets for about 20 years, a little under 20 years. I started my career in 2004. I've been at a few different investment firms over that time. And in 2021, early 2021, I decided to start my own firm, Recurve Capital, which is an investment advisor. I've spent the majority of my career investing in technology, media, telecom, and consumer-facing companies. I started early in my career looking at a lot of different telecom companies, which is why we're talking, I think.
Yeah, absolutely. There's only one T in the TMT that I really talk about a lot.
Right.
Yeah. Sorry, go ahead. Yeah.
Oh, yeah. I was just going to say that, the landscape has evolved a lot. And I've looked at the traditional carriers, emerging market wireless, wireline, cable, enterprise. I've looked at all of it over the years. And these days, there's not a lot to look at. There's not that many companies left anymore.
That's one thing we'll get to for sure. Yeah.
But it's so I spend a minority of my time on it today, but it's still something that I pay close attention to.
Well, yeah, and I've been looking for a guest on this topic actually, and one of the reasons that when we spoke earlier that I thought you would be a really good match for the show is that variety of areas within telecom, so that you've had some experience like on just like the mobile tower side and maybe enterprise services and all that sort of thing. That while sometimes there's a lot of vertical integration for the really big ones, there's a lot of going on. I think investment wise in all those different areas. So. Yeah, I'm looking forward to learning about that side that I get from my occasional interactions with customers who want some data from me related to this, right? So
yeah, sure, yeah,
excellent. So I thought, Aaron, we might just start out with kind of a broad introduction to telecom investing. So most of the people, of course, who listen to the show are directly in the business or maybe managing large networks, and maybe don't even think a lot about what the capital side thinks about in this industry. So maybe start out with just someone who's investing in telecom, someone who's focused on this like you. What are you looking for out there? What and you alluded to this, that this has changed over time, but what over time has been interesting about the telecom sector?
Yeah, sure. And before we get started, I just want to mention that there are disclaimers in the show notes, and I want to just reiterate that what I say is my opinions and nothing constitutes investment advice.
Yes.
So I just wanted to get that out of the way. So these are my own opinions.
Yeah,
So
we'll have notes. We'll have a whole officially
yeah,
legally sanctioned disclaimer in the show
right,
notes, but
right.
do not take this as investment advice, and it's its own risk. And you guys have heard that before, right? So,
Of
yeah,
course, of course.
yeah.
So I would say when it comes to telecom investing, I'd say there's two main camps that I think
Hmm.
about. I think there's the dividend yield, income oriented part of the market
Okay.
where it's defensive revenue streams, recurring revenue, steady cash flows, steady earnings, and a reasonable payout ratio such that you buy, whatever it is, AT&T or Verizon or one of these more steady, lower growth, lower volatility businesses, you can depend on that dividend coming through to you as
Hmm.
an income investor. Then there's the other camp, which is what I would call the free cash flow per share camp, and that's where there may not be a dividend payout. It
Hmm.
may just all keep rolling through the organization. Maybe they have a shareholder return program via buybacks, but not through dividends.
Right.
And the formula there, I think the quintessential example of that would be what the cable sector has done over time, whether it's Comcast or Charter, where they've had share gaining revenue growth.
Hmm.
Maybe it's mid to high single digit. Maybe it's in the old days. Maybe it's low double digit. They have a high fixed cost base, low variable cost base that makes earnings grow faster than revenues, and then they use the balance sheet and the debt capacity of the business to repurchase stock and drive the per share values higher over time.
Hmm.
And
Hmm.
I'd segregate the world, primarily the telecom world, into those two camps. Um, Increasingly, I think that the second camp is going to slowly merge into the first camp because there's just
Hmm.
not that much growth left anymore. And so
Right.
as growth decelerates, I think the income attributes maybe start mattering a lot more to those free cash flow per share stories that used
Got
to
it.
be more popular.
Okay, so in that first group, I think in the US, we would mainly call those like ILECs, maybe PTTs in other parts of the world. Is that from an investing standpoint kind of like the classic old utility, right? It's like very low risk, minor reward maybe, but you're going for that regular sort of dividend income kind of thing. Is that where mostly the sort of battle of telecom being a utility commodification? The reason I want to ask the question this way is that I know that if I had someone from a telecom company in the room right now, they would be doing absolutely everything in their power to tell me that they are absolutely not a commodity, right? So it's from the investor standpoint, I'm not going to get involved in that fight, but from the investor standpoint, is that right that they are kind of utility like, sort of a commodity like resource?
So I think the quicker any telecom company acknowledges that they are just a pipe.
Hmm.
And now the end markets are different, and the difficulty of those end markets can be highly variable. So
Of
a
course.
wireless pipe is very different from a wireline pipe. It's very different from a retail pipe, right? Like if
Hmm.
you're there's all these different players, and the dynamics change depending on how competitive your end market is. But I think the days of application specific networks I mean, we've seen what has happened to long distance voice and
Hmm.
video, and all of these application specific networks have been commoditized by the internet. And that is the ultimate, the internet has forced all of these networks to become dumb pipes. And
Right.
so what what differentiates one dumb pipe from another is cost, and that's why you've had price deflation and commoditization of everything, all services, all products that have run across these networks,
Hmm.
and it's made for a very difficult recipe for the equity investor because
Right.
you've had lots of capital deployed into these businesses, tons of debt taken on to deploy large networks that supported a revenue base that was much larger in the past, where there was a much higher price per megabit or gigabit of capacity
Hmm.
utilized on the network. And now those retail prices and consumer prices per unit have deflated at such a rapid cost curve or price curve that you're using, like, you know debt to support a declining business, it's ended up being value destructive to the equity investor. So maybe now you guys get much more in the technical weeds than I do,
Sure.
but so maybe it's not true that all networks are commoditized. But from my view, I feel like the answer is obvious. The endpoint is all fiber networks, all IP, and whether the last mile is fiber or a very high throughput wireless drop into the home, or coax cable to the home, the core of the networks that matters is fiber. And if you don't have that, I don't know, you're just kind of you're playing against time, competing against time, and you will be disrupted eventually. It's just a matter of time. So as an equity investor, you care about the sum of the discounted cash flows over the life of an enterprise. And if you think about how valuation works, you have kind of the years 0 to 10 are more visible. Years 11 and beyond are you're kind of guessing at what the terminal value of the business will look like. If you're dealing with cash flow streams that are based on non-fiber, non-end state technology, I don't know how you underwrite to that very accurately as an equity investor. You have to put a massive discount on the valuation of those cash flows. So you may be able to run out a DSL network for the next 7 years or 10 years, but you're not going to have it in 30 years. So how do you value that revenue stream and that cash flow stream from a commodity layer that's going to be disintermediated by better technology over time? It's a very difficult thing to assess. And the internet and the application layer has disrupted the service layer to a massive degree, the infrastructure layer to a massive degree. Amazon, Google, Instagram, Facebook, all of these applications, that's where all the value has accrued, even though these networks, which provide like mission critical utility function for the entire global economy, none of the economic rent has accrued to them, even as you've had massive volume explosion into these businesses. So,
except for where they're vertically integrated with those over the top services or whatever, right? So
do we have a great example of a network company that has a winning application?
Not in like UCAS, for example. I wouldn't think. Yeah, exactly. Yeah. Absolutely. And there were attempts at that, certainly. So with, you may remember these like kind of meet me rooms, right? Where trying to create sort of before Skype and Zoom, long before Zoom, before Skype even came along to sort of go over the top. And certainly. I mean, from my perspective, as more kind of the economic geography of it, the thing that I can really align with what you're saying is that prices are always going down, and almost very predictably, because they're following a kind of a Moore's law of the transmission, right? And demand is always going up, right? So although there's some limit to that, eventually, if we're all doing video calls and watching Netflix and gaming, it's not going to be at a whole lot more than that, but leave it to the content providers to come up with many more bandwidth hungry things.
If the metaverse is a thing, then maybe AR, VR puts another multiplier on all future per minute growth.
Exactly. But
per minute.
So for almost 20 years, I've certainly heard folks providing transport or wholesale IP transit, that kind of thing, saying like, these price decreases, I can't stay in business. Demand grows really fast and has kept some of them afloat, but I take it that's everything you're talking about is why we've seen, frankly, a lot of consolidation in that end of the world as well, right? So
and I think I was reading a white paper by Cisco, I think from like the early 2000s last week, and it was about DWDM. And there was a paragraph that was just so like mind blowing. And the paragraph said something to the extent of DWDM has potentially infinite capacity. It introduces potentially infinite capacity on fiber. And that's the problem, right? There's just an oversupply, and there's there's technology that enables more wavelengths, more capacity per wavelength. And you can just keep doing this over and over and over again. And if you have infinite capacity, what do prices do? You
Mm-hmm.
know, like maybe it's not all unlocked in day one, but as it's unlocked over time, you're just going to have price deflation. And by the way, that's good for society because look at all the
Sure.
things that we've been able to
Yeah.
achieve
Right.
technologically because of the very cheap network layer that we have.
Mm-hmm. Yeah, and I think maybe this would be my question for you in terms of, and again, we're not looking at investment strategies or whatever, but just from a kind of like almost like macro view of this industry, that they're still out there. AT&T, Verizon's, ILEX of the world, PTTs are going to be there. There's still a solid business. It's just not one that perhaps the investment community is interested in because it's a known commodity, if you will, right? That is a perhaps a safe bet for certain investing strategies, but that it's not going to have some kind of like unexpected movements or whatever. And this would be my question for you because I truly don't really keep an eye on this, but I assume that their stock prices, their PE that don't change a lot over time. The dividends probably don't change a lot year on year. Is that why it might not be interesting to the investment community?
Well, the stock prices can move around with the change in the risk-free rates and the treasury
Mm-hmm.
yields and things like that.
Mm-hmm.
And so the dividends,
Right, due to macro things
right,
more so
right.
than the company itself, right?
And the
So,
earnings have been, fairly stable, but still, um, you had, I think, low single-digit revenue increases last year
mm-hmm.
in AT&T and Verizon. I think Verizon is probably expected to grow 0 to 1% for the next few years per year,
Mm-hmm.
well below inflation, right? So
Right,
you're giving up real pricing every year in this business.
right.
I think the challenge is that you still have, at least in the enterprise side, you still have legacy revenue streams that are way over earning relative to what the
Mm.
over the top application or the newest application would be charging on a
Sure.
per unit basis. So
Enterprises that haven't given up their voice service and
right,
TDM and
exactly.
stuff like
And
that.
like, why would you? Because you're over earning, and like, should you turn off the over earning cash flows today just so you could bottom out faster?
Mm-hmm.
No, you probably shouldn't. You should probably take as many of those cash flows as the market will give you.
Right.
But from an investor's perspective, from my perspective at least, I'm not really interested unless either that security is priced so incredibly cheaply that
Mm-hmm.
I can stomach all the losses and it's embedded in the valuation for me,
Right.
or until those revenues have started to bottom out and the legacy stuff that's over earning is cleaned out of the revenue base and they can start growing again somehow.
Mm-hmm.
The problem is you don't know where the valley bottoms in the revenues, and until you have visibility into that, the valuation probably just compresses forever, essentially. There's some limits to how cheap stocks can get, especially these large cap stocks that are stable and have big,
Mm-hmm. Mm-hmm.
they have big investors that care about the dividend and the
I was
yield.
going
So
to
the
say
yields
because
can't
that
go
could be
so high.
attractive, right? Yeah.
Yeah.
Mm-hmm.
But there's a reason why Verizon trades at like a 7% dividend. Like, that's
Mm-hmm.
a stable business. Now, risk-free rates are much higher, but that's a very high dividend yield for a company like that that has shown a lot of stability over its life.
Right.
That tells me usually what you see is like, I think Lumen had like a double-digit dividend yield, and then that's the market basically saying, we know you have to cut the dividend. That's why the yield is allowed to creep that high.
Mm-hmm.
And then they do cut the dividend, right? And so the market
Right.
was right, and the stock collapses because now all the yield investors are gone. So,
Right.
there's a balance between the balance sheet health of these companies and the revenue trends of the businesses that they have to. It's a delicate balance. It's just there's not inherently there's just not enough growth to make it interesting for me because I don't care about clipping a 7% coupon. That's not what I try to do every day.
Sure. Yeah.
That's
Yeah.
that's just my style, and what
Mm-hmm.
what I'm attracted to or not is very different from what other people can be attracted to or not in the market.
Mm-hmm.
But I look for things that have more competitive differentiation that kind of already believe in the end state and have oriented their businesses around the end
Mm.
state of the industry
Mm-hmm.
that I see at least.
Mm-hmm.
And there's
Mm-hmm.
just not that many of those companies out there. There's maybe one or two.
Right.
For
Well,
me.
that's really interesting. I think so. So leave aside that. Okay, well, if I'm in a stage of life where I want my investments to be dividend producing, really secure, or whatever. That is one thing, and this might be interesting for that. But within and by I want to be specific because we could go really broad with this and include things like the hyperscalers themselves or SD-WAN providers and all that, but sticking to like transport layer, facilities based kind of telecom, that sort of thing. So you mentioned there's one or two that have a different philosophy. I don't know if you can, but if you can give us an example of that specifically or just generally to sort of show us what that might look like.
Yeah, I think the one company that I have found that kind of exemplifies what I'm talking about is Cogent Communications.
Mm-hmm.
It was a company that was created with the idea, with the built on the premise that the internet would win and it
Mm-hmm.
would
Mm-hmm.
outcompete all the network specific service layers that were out there.
Right.
Um, it, I mean, Dave Schaefer started the company with one of the most audacious theses that I've seen, which is that he could build a global IP network on a single pair of fibers and just ride the
Mm-hmm.
DWDM cost curves forever. And this is in a market that had been massively oversupplied by physical fiber built by Global Crossing or Level 3 or
Right.
PSINet, whoever it was. And most of those businesses have either gone bankrupt or been reconsolidated into what's
Lumen.
now Lumen.
Yeah. Exactly.
Right? There's like, or Zayo, I
Yeah.
guess. Like they've
Yeah.
been
Yeah.
consolidated into Lumen, Zayo,
Yeah.
maybe AT&T and Verizon have some of them too,
Yeah.
Legacy Sprint.
Mm-hmm.
But there's only one company whose revenues today are higher than they were 20 years ago, and that's Cogent.
Mm-hmm. Mm-hmm.
And it's because they started small. They started believing in the commoditization of the IP or the kind of long haul transport network.
Right. Rather than trying to deny that was the
Yeah.
case and find ways to. Also, can you give us a time frame for this roughly? Because I think it might relate to people who were in the industry that weren't concerned with investing. Certainly knew what Dave Schaefer and would. A lot of them thought it was wild, right? So
Yeah.
what time frame is he sort of having this realization and going through this process?
So I'm gonna my knowledge. I don't know how accurate I'm going to be, but it's going to be
Yeah, sure. I mean, general,
plus or
yeah,
minus. I believe he
yeah.
started the company in 1999,
99. Okay,
and
yeah.
raised about. I think he raised $500 million of venture capital with the intention to go build a global network that would eventually cost, I think, $2 billion in not just network costs, but also the operating losses to scale the business up.
Mm-hmm.
And then in the early 2000s, when the wireline telecom and fiber ecosystem just blew up completely,
Right.
Cogent was able to acquire a handful of companies. I think it was 13 or 14 companies that, including PSINet and others that had built out physical infrastructure. I believe they say $14 billion of gross invested capital. Cogent acquired for $50 million.
I was going to say, because that was exactly the reason I asked that question, is that if for my world, if I look at the price curves of what was maybe the currency of the realm then, like an OC3 Stem 1, Sonnet SDH kind of service.
Yeah.
The period of like 2004 to 2007 or so, or maybe even shifted a little. Again, I don't have my dates perfect either in my mind, but there's it's a roller coaster right there.
Yeah.
It's the fun part of the roller coaster right there. Now, things keep falling, of course, after that, right, year on year, but year on year for transport, we're looking at CAGRs of like, 10, 15, 20%, depending on if you have new submarine cable or something. It was not 10 to 15% in those years. It
right.
was, 50, 60 more. Right. So it was an auspicious time to be doing that.
Right.
Sorry.
It was just too much capacity was built out, and everyone suffers when there's too much capacity. So
right.
what was a big business that was built on huge volume growth as the networks were being built out initially, volume growth started to slow, and you had advances in technology and optical networking and routing where you got more capacity from the strands of fiber you had in the ground already. So
Mm-hmm.
it was an explosion of the number of strands of fiber and the capacity that you could put through a single strand of fiber, and
Mm-hmm.
that was massively deflationary. But it also, the balance sheets, the equity investors are the ones that lost, right?
Mm-hmm.
A lot of these companies went bankrupt. A lot of them got swallowed up by what's now Zayo or Lumen
Right.
or Cogent,
Mm-hmm.
and others. And but that's part of the capital cycle.
Yeah, yeah. I mean,
That's
it's
fine.
not like that's unique to this industry, right?
Correct.
So,
Yeah.
yeah,
There was
yeah.
some unique fraud in this industry, I will say, but
Well, yeah, Bernie Evers, right, and all that sort
yeah,
of thing.
exactly.
Right?
Yeah.
Yes, yes, for sure. If and listeners, if you're not familiar with that story, Google it. It's fun, right? But
Yeah.
yeah,
Yeah.
but yeah, we were saying before that I have fielded quite a few sort of like investor calls. There, people are familiar with like GLG, that kind of thing, over the years, and I don't get as many really at all as I used to, but they used to be a lot focused on level 3 CenturyLink Lumen, right? Was Do you think that's just because they were also sort of acquisitive during this time period? Why were investors focused on those companies at that time, other than for the obvious reasons that we already hit, that they're not going to have questions or be about something as solid and known as the big kind of ILEX?
Yeah. Excuse me. There was a time when, Jeff Story came into level 3
Mm-hmm.
and started executing a turnaround plan, um, and started, rolling up that industry. And also Zayo was doing the same thing. So there was a lot of consolidation that was happening in the
Mm-hmm.
wireline network world, the
So
wholesale
kind of as
market.
simple as that, just like
Yeah.
if they're going through this consolidation, we need to see how that might impact the stock price and that sort of thing.
Well, you could imagine that if a sector or part of the economy is too competitive, there's
Mm-hmm.
too much overbuilding of each other, and suddenly there's a wave of consolidation. Theoretically, that would be anti-competitive, right? And
Right, right,
the
right.
the severe price declines that the sector had seen may slow down or may be arrested. And that was the whole debate around T-Mobile acquiring Sprint, right? You're
Mm-hmm.
going from a
Mm-hmm.
four-player market to a three-player wireless market. You have basically same service level, same coverage for this industry. And when you consolidate the market shares, in theory, it would become less competitive, right? And I think to some degree that has happened.
Mm-hmm.
So if on the wireline side, you probably got a lot more interest in it because investors were trying to figure out whether or not that would lead to better revenue growth on an
Right,
organic basis.
right.
Because of the consolidation, does it heal the market in such a way that it becomes much more investable?
Mm-hmm.
And have they cleaned up the legacy revenue streams to such a degree that the newer growthier revenue streams start out punching the declining revenue streams? And at some
Mm-hmm.
point that probably happens. I
Right.
don't know from what level. Maybe they need to drop another 50%. I don't
Yeah,
know, but
it's really interesting. Yeah, I mean, I don't cover like consumer mobile pricing or whatever,
yeah.
so I have no opinion there. But I can tell you in the long haul transport, and maybe some of this has to do with the physical realities of those markets. So there is really a finite resource in spectrum, right? So only
Hmm.
so many companies can own the spectrum within a country and provide mobile service. That's not true for long haul transport. There's, like you said before, Cisco wasn't wrong. Maybe in some theoretical sense there are limits. There's a Shannon limit
Sure, of course.
of
Yeah.
but you can it's expensive, but you can put more fiber down too. And terrestrially, it's not subsea, but terrestrially, when you do bother digging a hole, they just dump reams of fiber into that hole, right? So
Right.
from my perspective, I haven't ever seen consolidation lead to an increase in prices. Maybe without it, prices would have decreased more than they did. I can't run the Monte Carlo machine, right?
Yeah.
Yeah, it certainly hasn't resulted in stable or increased prices in my experience ever. So
I think the general problem that I have with the telecom industry is the prisoner's dilemma of spending capital. And
Mm-hmm.
everyone can assess their single company capital allocation decisions around, okay, if we make this decision, it's going to reduce our cost per unit by whatever percent. Or wireless is really easy. If we buy the spectrum and it's 5G spectrum and we can run all the latest technology on it, it'll increase our spectral efficiency from 4 bits per hertz to 70 bits per hertz. Isn't that amazing, right?
Right.
Yes, in a vacuum, that would be amazing if no one else were doing it, and you could
Mm-hmm.
suddenly outcompete everyone else in the market by offering a better value, better price,
Right.
and better service levels. But the problem is when the entire industry deploys, I think AT&T spent like around $35 billion in the C-band auction, and Verizon spent more than that. I think above
Mm-hmm.
$40 billion. All for what? They don't get any new revenues. They
Mm-hmm.
might have like a 5G unlimited, like, platinum kind of band of service or plan out there that is a $5 or $10 a month premium relative
Right.
to the cheapest or the more mainstream level of service. But it's not. They're never going to get that money back. It's just
Mm-hmm.
a very low yield defensive spend because everyone else is doing it. And I
Right. You
think
have to do it.
that,
Yeah.
yeah,
But
yeah, you have to
yeah.
do it. And it reminds me of, like, Warren Buffett in one of his shareholder letters from the 1980s talked about the textile business and how there was an investment opportunity to lower their costs. But he talks about it just destroying the economics of the entire industry because everyone put more
Mm-hmm.
capital in so that they could lower their costs. But by everyone doing so, it set a new baseline,
The
and
price
all the
fell. Yeah.
gains
Yeah.
went to the
Yeah.
consumers, right? It
Right.
doesn't
Mm-hmm.
go. It doesn't. The value is not accruing to those companies that are investing in the capital. And I think that's
Mm-hmm.
been the challenge for the telecom sector. Now, there have been, like, the pockets where it's been interesting as an investor have been these local monopolies or
Mm-hmm.
local duopolies, whether it's, the cable sector for, the last several decades, or
Right.
the cell tower business where there's so much NIMBY protection that, like, you can't just sprout up a new cell tower anywhere.
Mm-hmm. Mm-hmm.
And so a lot of the economic rent does accrue to companies like that. But when it comes to these oversupplied wireline networks and even the wireless networks, there's just not a lot of value that will accrue to those network companies
Mm-hmm.
because of the oversupply issue that they have.
Right. Yeah. So that's a great point. That everything I've been talking about tends to be on the kind of backbone level, if you will, or like long haul
Yeah.
transport. Is there, as you alluded to just now, interesting opportunity to look at, and for for folks like from within the industry, like we might say local access prices are there's a lot more margin than there is for long haul in situations where you have some kind of geographic advantage for
Yeah.
having gone through the trouble of digging trenches. So and I think you would probably call that economic rents, just so that everybody listening is on the same page, right? The extraction, correct me if I'm wrong, but of more value than one might have expected from that, essentially, is what you're saying, right? So um
Yeah. Yeah.
yes.
One theme I've been digging on or trying to research, although it's somewhat challenging to do as an outsider, is what the hyperscalers are doing in this business,
Hmm. Hmm.
because they are massive consumers of everything, and
Right.
whether it's raw capacity or physical diversity, route diversity, they
Hmm.
want it all. And
Right.
the old networks are built for very different applications. They're not necessarily built for what cloud computing footprints look like today
Right.
or in 10 years from now, when you run out how many of the workloads will be put in the cloud, the public cloud, and the infrastructure needs are tremendous, and
Hmm.
the connectivity needs are also tremendous. And I've watched these presentations by Azure, by AWS, talking about, like, the fiber fabric that they have to assemble
Right.
to enable, like, however many nines of reliability they promise to their customers.
Right.
And there's possibly a lot to do there. I've talked to some of the guys that buy these services within those companies, and the appetite seems insatiable to me. The traditional players, like we just talked about, all of the networks kind of reside in just a handful of companies now. And those companies are not heavily investing in new capacity. A lot of them you probably know this better than me, but I hear, at least in the marketplace, that many are reluctant to sell dark fiber, which is what these
Yes.
guys want.
Yeah.
The wavelengths and point-to-point solutions I think, seem to be a good and growing business. So there's a chance that because of the demands and the needs from the hyperscalers and others like that, others running on hyperscale infrastructure, that some of these oversupplied networks could see new revenue streams, whether it's wavelengths or dark fiber or other, that could start reversing that kind of perpetual decline in the revenue streams if there's enough demand coming for probably on different dimensions of value, whether it's geographic diversity. If it's just like a raw pipe from like LA to San Francisco,
Right.
you're probably not going to get any excess value out of something like that. If there's like, 5 other providers that run the same data center route. But if you can bring some uniqueness, or add different dimensions of value, whether it's route diversity, uniqueness, resiliency,
super low latency or
something
something like that. Yeah.
A straighter path. Like I was talking to one guy who said, we buy so much between LA and Phoenix, but if you could build me a straighter path and reduce my latency, I would buy it. Even though we already have so much capacity running between those two, because number one, it would inherently be diverse, and number two, it would reduce the latency, and that matters to me. So I think there are definitely opportunities where some of these companies can think differently about the way they add value to the customer instead of just, the traditional network business that they're used to.
Yeah, and some of that
revenue streams.
See if you agree with this, but was a little bit maybe some response on the provider side to the hyperscalers pushing them to do that. It's not lost on anybody in the industry that like Google Fiber, for example, was a play to say like, hey, we can build our own networks, right? and then they certainly did. All of the large content providers / hyperscalers invest in submarine cables, for example, and whatnot, right? So they still, of course, buy massive amounts of capacity from the traditional providers, but they're out there with their own sort of vertically integrated supply as well, right? So,
well, if you think about it from their perspective, the supplier base that you're dealing with is shrinking, it's consolidating, and if you're talking about like a Lumen, right? They've sold off a lot of their assets. They just cut their dividend. They don't look financially like that sound. And if you're Microsoft or Amazon or Google or Meta, do you want to build a business plan that relies on 1 or 2 companies to do what you hope they do? It gets really challenging. When I started my career, I think the first sector I ever looked at was the cell tower industry. So I apologize if I refer back to wireless too much.
No, not at all. I think that's actually really interesting to bring in. Yeah.
But in wireless, like, the carrier portfolio, tower portfolios got acquired by these tower companies, and then they brought in the multi-tenancy model, right? And because of the NIMBYism and because of the relatively small radii that a cell tower, fulfills, in terms of mobility demand, there just wasn't a lot of like competition to oversupply that market, and you got additional tenancy, which brought like very high margin additional revenue, incremental revenue streams. The cell tower companies are a cost of service to the telecoms, right? So they sit senior to every other debt instrument in the capital structure. And because of that, their cost of capital was below that of their carrier partners, the carrier customers. In this market, what I think is interesting is that, nobody borrows more cheaply than the hyperscalers because they're huge, profitable businesses. But their suppliers for this critical infrastructure borrow much more expensively and have less incentive to just go build new network and fulfill the needs of these customers, even if they see them. They may not be able to meet the return thresholds on the first tenant because of their cost of capital. So I do think that the likes of the hyperscalers, whether it's Azure, AWS, GCP, I think they are being forced into building out some of their own infrastructure and doing it more vertically integrated. And they already are so vertically integrated. As I went down this research path, I learned a lot more about all the proprietary hardware, software, networking, everything that they have to build in-house. Or with AWS, it's Graviton chips and like their own custom silicon. Like they go all the way, soup to nuts proprietary tech. And it wouldn't surprise me if we see them a lot more active in the network infrastructure layer.
Yeah, just because that's really interesting. And especially when we talk about edge, for example. So when you're talking about cell towers, and this is not my area of expertise, but I know enough to make me dangerous maybe, but with 5G, that radius is even smaller and there's penetration problems. So you have to have a network of towers rather than just, so on 2 through 4G, if you're walking along, say, and you turn your head, you're still in contact with that same tower. On 5G, there has to be a tower on either side of your call because your head is enough in some of the frequencies they use for 5G to stop the signal.
Yeah.
But from what I've read on this growth here is that where those high density of 5G towers is available now is not where it's really necessary because certainly from a sort of fixed wireless standpoint, right, that it's in very dense urban environments. It's entirely after the sort of consumer mobile market, but for like the business 5G market where you would need that would be where you can't get wireline service very easily. And that's precisely where there's no incentive to build it out, right? So I wonder if as edge becomes increasingly important to the hyperscalers, that if I want to encourage people to do this edge computing, which often when you talk about like things like MEC, like happening at the tower, that the hyperscalers would kind of say like, well, we need more physical infrastructure to sell these edge services because that's the whole point of edge is it's close to the consumer, right? So and if my options are like, a rural ILEC, or something like that, to be able to get close enough to my consumer, then that's not going to cut it. I have no idea, but I'm just curious if you see things going in directions like that.
It's hard to know. There's densification and fragmentation of everything, and in the mobile networks, I think what you said is true if you're talking about the very high frequency spectrum.
Right.
So far, we've been building networks. I remember 7 years ago there was a debate over whether or not Sprint's 2.5 gigahertz spectrum could be mobile spectrum, and now everyone's building their networks at C-band, which is like the high threes, threes, low fours. So the technology gets better, the networks necessarily get denser. You're also going to small cell networks where it's fiber fed, these small nodes that go up on like street poles and street lights and stuff like that. I do wonder when it comes to mobile edge, people have been saying that you could put a mini data center in the sheds next to the cell towers. However, like those are like the big macro sites where you have, that's kind of your coverage layer, not necessarily your capacity layer. And so if you need it to be distributed throughout the network where you have, especially where you have high capacity needs in like dense urban or whatever, you don't have a shed next to a street pole. You have to consolidate at some other POP like within that area, right? So I'm not sure how it all plays out. Honestly haven't spent much time thinking about it. It's not really something that's, for me at least, investable at this moment. So
right. Yeah, no, I mean, interesting stuff to watch. All right, I think where I might sort of go to wrap things up, Aaron, this has been really interesting, is just what do you find most interesting in the market right now? Obviously you've been talking about that the whole time, right? But if you had to sort of distill it into a takeaway, what is interesting in the telecom and investment world presently?
I think there's, my strategy is much more of a rifle shot strategy. So I try to pick, a very select group of stocks, and situations where I think I can assess, um, how things may play out. And in the telecom market, like I said, in order for me my starting point has to be that the company, for me to want to buy a stock, I have to believe that the company believes in kind of the end state of the industry, which is fiber everywhere and, commodity.
Ubiquitous capacity for everyone. Yeah,
ubiquitous
exactly.
capacity. And so what does that leave me with? It leaves me with any company that I believe is the low cost producer of capacity in its end market. And has a structural reason for kind of sustaining its cost advantage over time. That narrows the universe tremendously. There, I'm going to refrain from talking about specific companies, but
of course,
I own, one company in wireline and one company in wireless, and those are the only ones that I think fulfill those conditions.
Right.
There's a lot of moving parts, especially in consumer-facing telco,
Right.
cable and telco. There's a lot of overbuilding. There's a lot of new networks being built and into rural and suburban, and cable going to fiber, copper going to fiber also. There's a lot of different moving parts. And I think it's really hard to, for me, it's easy to just eliminate as I see some of these dynamics. I'm like, that's too hard for me. I don't know how to assess the terminal value.
Yeah.
I'd rather play in areas that are more predictable. But in the telecom market, because it's a commodity service at the end of the day, or a commodity pipe at the end of the day, if we believe, if my premise that like every network eventually goes to all fiber, all IP for the core of the network, and that there is unit price and cost deflation over time, then is there an interesting business attached to being the low cost producer of capacity in that end market? Sometimes you can be the low cost producer of capacity and it's still a crappy business. It's still a crappy stock. It doesn't matter that you're low cost, because I dealt with this investing in European cable years ago. Cable has an advantage over copper, but a cost advantage, a speed advantage. But there was so much retail competition from the way European telcos were regulated, with local loop unbundling, and
I was going to say,
much more retail competition on basically a duopoly network situation, but much more retail competition. It didn't matter that cable was so much better as a network than much of the copper infrastructure out there. All of that just got competed away by the retail competition. So it doesn't. That's a starting condition for me. And then there's a lot of other things that I look for to reaffirm that it's actually going to be a good investment and a good business longer term. But that's why the telecom sector is so difficult to invest in, because there's just been a lot of competition, and it's also been heavily regulated. So that's a really bad combination for value creation longer term. So anyways, I don't find a lot that's exciting in the telecom sector. It's very selective and it's very idiosyncratic, I would say, to the things that I like.
And this may be totally out of your purview, but I think to close up, I'll ask this question: Do you think it's more interesting, maybe in if we look further up the stack, right, if you will, at the startups around things like, whether it's AI/ML for networking, sort of SD-WAN, those kinds of things, where it's still sitting on top of that commodity layer of dumb pipes, but they're doing networking differently with new software and that sort of thing. Do you, even if you haven't looked into that deeply and whatnot, do you think that might be interesting to the investing world as a piece of telecom, or do you just end up considering that to really be software, IT kind of oriented, rather than actually a part of the network itself?
Well, I don't know. Is Amazon tech, or is it consumer, or is it networking, or whatever? It's all these lines start to blur over time. So I don't know if the distinction matters that much. my gut reaction to your question is that technology is rarely a sustainable competitive advantage, and
Mm-hmm.
building a
Because you can't
differentiated
keep it
business.
secret, right? So
Yeah. So,
yeah.
like it's really hard. I have a particularly hard time assessing software businesses because they may
Mm-hmm.
look good and I've invested in software companies over time, but they
Mm-hmm.
may look like they can grow for some period of time. But we're now in an era where software can write software. Maybe
Yeah.
not unassisted, but
Mm-hmm.
it can do a
Mm-hmm.
lot of the heavy lifting. So what
With a
might have
really good
cost
prompt. Yeah.
yeah,
Yeah. Absolutely.
what might have cost $100 million of development costs for a piece of software, good like really really good application software or infrastructure software, maybe in
Mm-hmm.
10 years could cost a team of 10 people $1 million,
Right.
and they could do it on a variable basis with usage-based cloud computing budget and deliver it globally at Amazon or Microsoft scale as needed. So it's to me those businesses are also really hard to assess because the business models inherently look sticky, just like telecom revenues.
Mm-hmm.
They are sticky. The customer relationships are sticky, but it feels like a part of the market that if it's a good solution, it will be replicated 100 times.
Mm-hmm. Yeah.
Like
Yeah.
I'm
Absolutely.
not
Yeah.
sure. I'm not sure like what differentiates one versus another, and definitely
Mm-hmm.
not confident in my ability to choose which ones
To pick
will
which one. Right.
will win over a 20-year horizon,
Yeah.
right? Or
Yeah.
even a 5-year horizon. It's just
Mm-hmm.
the growth. I've seen enough situations where the growth goes from exponential to GDP like within a few years.
Right. Right.
And it's because there's new competition. And a lot of investors, they like to find like the big trend and the hot trend, like, oh, there's a lot of investment going to AI. Like, I'm just going to
Mm-hmm.
buy this trend. And I'm much more focused, my process at least is much more focused on what's the good business that falls out of
Right.
this. Is there, the trend may be one thing and there's like, FOMO around
Mm-hmm.
wanting to be involved in that trend. But I always fall back on, is there a good business here that I can really kind of underwrite within a reasonable band of like outcomes, such that
Mm-hmm.
I can deploy capital in a way that is an attractive risk reward, because a lot of these things are more speculative in nature and there's hot money and chasing them, and because the trend is so big. So it's it creates a lot of dangerous places in the market
Mm-hmm.
when there's like
Right.
a big trend like AI, ML, and like point solutions that are growing extremely rapidly today. But in 5 years, maybe there's 20 new competitors, and you have no
Mm-hmm.
idea who's going to win. And
Right.
probably the answer
Yeah.
is, in the same way as the telecom market, the consumer wins, and
Right.
the services that like turn that into an application layer on top of the infrastructure layer, whether it's an Amazon or an Uber or a Google, those guys all got to ride on the network layer being commoditized over time
Right.
and
Mm-hmm.
build their own moats that were separate from the network layer and the infrastructure layer. The, I don't know how to. That's really hard to predict, also. But I imagine, as in most things in the business world, consumers end up winning most of the time, and it's
Mm-hmm.
very few businesses that end up winning longer term.
Mm-hmm. Mm-hmm. Or they get subsumed by the businesses that won for other reasons anyway, right? So
Yeah,
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 yeah.
yeah. Interesting. Well, this I could keep going on this for a long time, Aaron. So I hate to cut it off in this case because I find this really fascinating. It's really interesting to me to see a totally different vision of the kinds of things that I'm looking at as an analyst for the industry within the industry all the time. And truly, like I said, I truly don't even look at the stock prices for most of these companies and whatnot. So I think it's fascinating to think about them in that long term sense rather than in the sense that I normally think about it, which is like, okay, well, what's going to happen with network prices in Sao Paulo this year or whatever, you know what I mean? It's like very sort of granularity instead of pulling back. So it's been really interesting to me. Thank you very much for all those insights. Yeah.
Can I ask you a question?
Yeah, please. Absolutely. That is awesome. I hardly ever get that on the show, so I love it. Yeah. So, yeah.
So from your perspective, do you see, I mean, this is for my own education, do you
Mhm.
see pockets of the telecom market where there is less competitive intensity or where there's real differentiated value being created that we
That's
haven't
a
talked
great
about?
question. Yeah. And so one answer is obvious but complicated, which is that, geographically, right? Like, if you own a portion of the network that no one else does. Now, this can be for a bunch of reasons, right? One obvious one being government regulation. So if I would not mind owning network in Dubai that was officially licensed, right? You know what I mean?
Yeah.
Because I know what kind of margins they're getting, right? But the more sort of quotidian one would be that I have built out network where someone else hasn't and isn't likely to do so. The
Right.
problem with that as a competitive advantage is that it's really expensive to do that, right? You know what I mean?
Yeah.
So digging trenches is really hard, and that's why only one provider has access to your factory that's in the middle of nowhere. Now, where things might get interesting is when you have things like LEO satellites, right? The Starlinks and the Kuipers of the world that have the potential. I don't know if it'll really happen or if it will be sufficient for this, but if all of a sudden you have access to sites that wireline is truly difficult, yeah, there's, I think, something interesting there, because there are a lot of difficult places around the world. Most of them have the feature of those aren't what multinationals are interested in, because they
Yeah.
but that is not always true, right? There's plenty of situations where multinationals and or consumers are in those places, but they just don't have access to wireline service yet. So I think that's one place. I think the you know in terms of the network itself, right? Um, you're I think you're right. The problem of that, like, if a new technology comes along, it's from an OEM, like outside the network operators, right? That will sell it to whoever. So if I come up with a better way of transmitting data across fiber, then I sell that to every carrier who will buy it, and it's just constantly a race to the bottom. So of course they all know this, and I think one of the things they're trying to do is think about what are different business models for selling networks to people. And so in that vein of things, I also think the network as a service thing is a potentially really interesting place, right? So
Yeah.
where the difference isn't anything that we've been talking about, but it just in how do I structure the contract, and how do I facilitate the lower transaction costs, essentially, right? Making a more fluid network purchase, right? So
Yeah.
and again, the whole industry knows this, and they're going towards that. But I do see some really interesting potential in the whole network automation. The reason I brought up AI is AI to do things like provision service immediately and without any humans being involved whatsoever. There will be a time where that is a competitive advantage. If you're still the carrier who is getting trouble tickets and orders and all that sort of thing, and someone else has moved to an AI system that does that immediately through a portal, I could see that being pretty interesting.
Absolutely. For a period of time, absolutely agree.
Right, that's the thing. uh,
Yeah.
it will not be able to be hidden from those other providers. So
Yeah.
yeah.
I do wonder, one of the questions I wrestle with on this hyperscaler topic is the hyperscalers are constrained by access to cheap and available power, enough of it,
Hmm.
by networking and, you know, I mean, it's basically those two things, right? You can stand up a data center in the middle of nowhere, but you
Right.
need to have access to the power and enough of it, and you need to have access to the connectivity, and
Hmm.
enough of it.
Yeah.
And I don't know. We're running out of space in like Ashburn, right?
Yeah,
Like
for sure.
Ashburn is
Hmm.
completely packed with data centers.
Hmm.
We're running out of space in Silicon Valley. Like these historically like uh, big hubs of connectivity and data center capacity are running out of space. And I think maybe also running out of power to some degree. I'm not
Yeah,
really
I mean,
opposed to that.
yeah, absolutely.
But I know that Amazon and I think maybe Microsoft also is like building out these big facilities and campuses, data center campuses in like rural or not Oregon, like 150 miles east of Portland on the river, and
right.
that's a place that has a tiny population. I think of like under 20,000 people, but it's probably becoming mission critical infrastructure for the regional economy, even if they don't know it. So if I do wonder if there's something there to be an arms dealer in that part of the market and just like follow them wherever they go and be not just a single provider, but is there a cell tower? What I'm wondering is there a cell tower model in there somewhere where Amazon doesn't want to build it themselves just for their own. Maybe they're happy to and willing to, but if XYZ company could build it and both and Amazon and Microsoft and Google and Oracle and Meta all put a new data center campus in all these new locations because they have plentiful land that's cheap and cheap access to renewable energy or whatever. This is greenfield that could be like a multi-tenancy model that might be a good business. I'm kind of wondering about that. I'm not sure, but I do wonder if that's like a potential new, better revenue stream for the next generation of networks that's going to be required to support all of this off-premise computing.
Yeah, no, I think that's interesting too. I think there is a small potential. Again, this is complicated because it gets down to very traditional things, not technological at all, like rights of way and the shortest path between 2 points. And then the technical side of like, are there efficiencies to be gained in terms of having fewer routers? Every time you hit a hop, that increases your latency a little bit, right?
Right.
So I think there is potential for something interesting there, where if the data centers are chasing cheap land and cheap power, which is by far more concern cost-wise for them than fiber, right? Then the fiber providers who can make that work for them in terms of latency, I think if that is possible, that's the thing. You know what I mean? I to the extent that is possible, I think that could be really interesting for sure.
Yeah. But as an investor, how would you even play that? That's part of the challenge, right? There's just not that. If let's say all that interesting stuff is happening within Lumen, but you have to take all the legacy stuff with it, it's really challenging. Especially because Lumen historically has a business that, from the investors, at least from my perspective, I shouldn't speak for all investors, it is a gigantic black box of revenues, and it's really hard to pull out what the underlying products and services are, what the trends are within them, and what's happening under the surface. So
I mean, if you look at your whatever 10K report, it's hard even to just extract what of this is going to the enterprise sector, what is going, let alone what does it matter if they're extracting some extra value on these particular routes or situations, right?
At the end of the day, investors want to see it in a very like easy, simple, consumable way, which is that top line revenues are stabilizing or growing,
Exactly.
and that the margins are not deteriorating anymore. So you can bring all the complexity you want with the storytelling and the particulars, but you're not going to get benefit you're not going to see the stock benefit until it's pretty clear what's happening under the surface, based on what's reported in the high level financials.
Yeah, absolutely. Yeah. Excellent. Well, this was really, truly interesting, a delight. Thanks so much for joining me. If folks want to find you, keep up with what you're doing at Recurve, is there a way to do that?
I'd say the best way is to reach out on LinkedIn. I'm on LinkedIn. That's probably what I would point them to.
Yeah, absolutely. I always joke on the show, I've literally like never had a Twitter account, so LinkedIn will do for now. All right. So, yeah. Excellent. All right. Well, thanks so much, Aaron. It was great talking with you. Thanks for listening. Telegeography Explains the Internet comes from the experts here at Telegeography. It's edited and produced by Jane Miller, and it's hosted by me, Greg Bryan. And I also wrote that theme song you're listening to right now. To learn more about our data, jump over to telegeography.com and we'll see you on the internet.